Good evening. Welcome to Money Matters. I'm Charlie Shields of Wells Fargo Advisors, which is a SEC corporation, and my co-host tonight is Pat Dunn, who is with Merrill Lynch. Pat, good to see you.
Good to see you again.
Our special guest tonight, David Weiman, is a doctor, a PhD of Weiman Consulting, and he's going to talk a little bit about the psychology of personal finance. It's going to be a great show. Stick with us. So, Pat, let's talk a little bit about the turmoil in D.C. And I'm pretty confident, even though this show is taped and it won't be airing at the same time in different places to be viewed, there will be turmoil that people will see what we're talking about, whether it's in 2 weeks or 3 weeks.
Absolutely.
So anyway, that doesn't seem to be affecting the market too much. What do you make of that?
It's not affecting the market at all. So I guess if I were a contrarian, I would say turmoil is good. But it's very interesting. There does seem to be a distinct disconnect between the turmoil and what's going on in the market.
Yeah. Well, I just have a hunch, and this is a hunch, but I believe that the market is confident that we'll get the corporate tax cut. And so they're not worried about that, and they may not get it until later in 2017. But I think as long as they're confident of that, that can keep an underpinning in the market. What do you think?
I agree, and I think you're right. I think it's going to take the passing of the health care bill before we can get to the tax bill.
Okay. Also, the Fed continues to talk about and actually do some rate increases. And the common wisdom before they started this was that the long-term rates would go up at the time they were doing that because they would be fighting inflation. And the long-term rates are pretty stable. So what do you make of that?
Well, maybe the thought is that long-term rates are stable because the market isn't as healthy, or the economy isn't as healthy enough to warrant raising those long-term rates.
Okay, so if the Fed has promised 2 more rate increases this year, they may have to be flexible, and if the economy looks a little soft, maybe they back it off to 1. And my personal feeling is with rates somewhere just below 1 right now, a couple more quarter-point hikes shouldn't really wreck the economy.
No.
But I think the Fed has to be careful when they put those in place.
I agree.
Okay. Well, let's talk about smart ETFs. When these exchange-traded funds first came out in indexes, they tried to mimic a certain thing like the S&P 500 or some Vanguard emerging market index or what have you. And now we're starting to hear about smart ETFs where they're juicing them up a little bit. And that kind of makes me think that they're really starting to build mutual funds when they start messing with that sort of thing. And I've been hearing that a lot of them are starting to reach toward the stuff that's going up, the FANG stocks. And if too many of those ETFs are buying too much of the FANG stocks, pushing them up more than they should, that could end badly, right?
Well, you and I were both here in the late 1990s, and we know firsthand that it can end badly.
Yeah.
So you and I have been in the business an awfully long time.
Yeah.
We've learned the hard way not to chase things that seem too good to be true.
Yeah, March of 2000, by that time, we had small cap and mid cap mutual fund managers all buying the same 10 stocks, Cisco and Microsoft and all that, because those are the only things going up. So I'm not sure we're there yet. Cisco had 75 times earnings back then and needed to earn 75% of all the earnings in the S&P 500 to justify that. With stocks like Apple at 18 times earnings, it's not time to panic yet, but I think it's something that bears watching.
Absolutely.
Okay, let's talk about the small cap stocks and the way they behaved fairly recently. As soon as there was talk that the corporate tax was going to come down to 15 or 20%, there was also a proposal that the small companies, which are in a lot of cases C Corps and S Corps, that they were going to try to give them a 15% tax rate, and the small caps really took off for a week or 10 days or what have you. And since then, they've backed off. Do you think the small cap stocks need that income tax cut for the owners to do their hiring and all that?
I do believe there's a direct correlation, Charlie, because if the owners are paying less in taxes, then they have more money for reinvestment in their firms. So I feel that it might not be the sole answer, because another big player in the small cap arena is what's going on with the dollar. Because they don't tend to be major exporters.
Yeah.
So if the dollar's behaving the wrong way and it's impacting the large cap stocks, that's a benefit for small cap. So, but definitely the tax situation is a big plus for owners of small cap companies.
Sure. And then the other factor is, how expensive do blue chip stocks get? I know a lot of money managers and financial advisors have had their clients in those big, safe stocks, the consumer staples and that sort of thing. And in some cases you see where stocks that are selling tissue paper or toothpaste are at 25 times earnings. And if people start seeing the small cap stocks are at 13 or 14 times earnings, they may just say, regardless of the tax benefit, let's start putting some money in these.
The smarter investors, a lot of those people that are buying those big consumer durables or consumer staples, are doing so for the dividends. Because it's really been a race for yield, and in some cases you can get better yields there. But then you have to sit back and say, wait a minute, I'm owning something at 25 times earnings. How much more can this go up?
Good point. Well, let's look overseas for a second. Lately, emerging markets have been making a pretty nice move. Do you lean toward the developed overseas markets or toward the emerging market stocks, or do you have a blend of both? How are you facing that?
I actually do a blend of both.
Okay.
Emerging markets are very dependent upon commodity prices. So when commodities are doing well, emerging markets are doing well. But there is so much value right now in the overseas, particularly the European market. Things have just been beaten down to a pulp, that there's some very good buys there for the patient investor. And interestingly enough, the European markets have been outperforming our domestic markets. That's very rare, but it's something we're experiencing right now.
Yeah, and I think the preliminary election in France kind of tipped the hand of how that was going to come out. And so it was kind of a non-event when the official final results came out. The stock market didn't react either way, but there had been a good run-up prior to that time. And still, the developed markets are cheaper than the U.S. markets right now.
They are.
Okay, and maybe they're cheaper for a reason, but I guess we'll find that out, right?
In time.
Okay, well, let's talk about healthcare and biotech stocks. First, before the election, Hillary Clinton was saying that biotech shouldn't be able to charge much, and there was big publicity from certain dramatic increases in price in biotechs. And then it seems Trump, since he got elected, has been bringing up the same subject, that he wants to make sure that the healthcare companies and the biotechs don't charge exorbitant amounts. The problem, of course, is they have to spend a lot of money to find these cures. So do you think they'll stay down, or do you think they've been beaten down where there's probably a good area to look right now?
Actually, I think it's a good area to look, because once we can pass this healthcare plan, a lot of that uncertainty, I think, will get lifted. And we're still dealing with an aging population and demographic shifts. So I feel that healthcare is a sector that I want to be invested in.
All right, and speaking of the healthcare and the how this thing is going to shake out with changing the Obamacare, I think a lot of people are interested in eliminating the limit of 49 employees. You should be able to go up to 55 or 60, and then not have to worry about whether your taxes change dramatically like they did under Obamacare. So I hope they at least make that change, and that would help the small cap companies if they do change that rule.
Most definitely.
And then the other thing that used to bug me is that there'd be people on one corner that was McDonald's and another corner that was Wendy's, and they had the employees walk across the street and change uniforms, so they were working 30 hours a week at both places and weren't subject to Obamacare. And it'd be nice if they could keep the same uniform on and work in one place and get some medical benefits there. So there's a lot of things that need to be changed, and there's some things we should keep, right?
Absolutely.
Okay, good. Let's talk about bank deregulation. Okay, obviously the smaller banks have trouble keeping up with the big banks and how many people they can hire to keep up with all the regulations. I get the impression that maybe Trump is going to be trying to kind of favor the smaller banks. I hear him talking sometimes about breaking up the big banks and all that sort of thing. So what's your outlook there? Do you think that people should be looking in the small and mid-sized bank area?
That's a real iffy thing. Financials do very well in this environment, particularly in an environment of rising interest rates. But on the other hand, these regulations that the banks have to deal with are absolutely crippling for the smaller banks,
Sure.
which is driving them to merge with the bigger banks. On the other hand, the bigger banks have gotten so big that now we're starting to hear rumors afloat is, should we bring back Glass-Steagall?
Mm-hmm.
And so I think it's definitely an area where you want to be invested. I wouldn't put it down as we have all the answers. I think a lot of these answers are going to have to be worked out over time. But like you said about moving the employees back and forth between Wendy's and McDonald's, this is an area that really needs to be addressed.
Fair enough. Well, let's try to help one of our viewers. Jerry Norton of Marion says, is it true that the new regulations will go away from the commission business, forcing investors to be in fee-based accounts?
Jerry, you ask a very good question. And it's a question that has an awful lot of investors quite puzzled. Let's start at the beginning. These new regulations, which hopefully will become law in June, may yet be delayed, but at the moment it's June the 9th, only affect retirement accounts. That is your IRAs, your Roth, your 401ks, your 403bs, and for small business owners, they're simples. It does not affect personal non-retirement accounts. As for the commissions are still going to remain in the do-it-yourself market for retirement accounts. So if you're going to an E-Trade or what have you, you will pay a commission because there's no fiduciary responsibility whatsoever on the provider of a do-it-yourself operation. So commissions will remain there. Now, whether you pay commissions if you're dealing with a firm very much is going to vary from firm to firm. And those who do want to continue to charge commissions in retirement accounts will have their clients sign what's called a best interest contract exemption form, saying that the provider does not have to do things in the best interest of the client. Now, going forward, yes, fees are going to become more prominent because it's through fees that we get transparency for the level of service received and the price paid for it. But that's something that will evolve over time, and right now it will only apply to retirement accounts.
And investors might be surprised how reasonable fees can be, and in some cases they're deductible. They have to check with their own attorneys and accountants to make sure about that. But I wouldn't just write off the idea of getting in fee-based accounts without checking into it.
Absolutely.
Okay, well, thanks for that help. Excellent answer, Pat. If you have a question, we're going to show you how you can send it in so we can get you a good answer.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Okay, we're back on the show here. We're our special guest, David Weiman. Dr. Weiman, thanks for being here. How you doing?
Good. It's good to be with you.
Good. And your organization is Weiman Consulting. Let's talk a little bit about the psychology of personal finance.
It's a fascinating topic, and there is so much to it. I'm reminded of a comment that Susie Orman made in one of her books, that everything financial is emotional also.
True.
Okay.
True.
That might make sense.
Now, in your experience, what is it that affects people in the way they handle their money?
I think it goes back to their first experience with it. And when I'm working with groups and seminars and even individuals, I often ask them to tell me about the first thing that they ever did to earn money. And they kind of look up, you know, and they trace it all the way back. And sometimes it was doing a chore at home that they got paid for. Sometimes it was a part-time job, maybe something simple like a paper route. But as they start doing that travel back in time, you really get a sense of what lessons they learned as kids about money. And I think that's really where it starts. So part of it is their upbringing and how money was discussed or not discussed at home, and what lessons they learned from that. It's sort of interesting, these take a child to work days they have now, which they didn't have when I was a kid. But that's another opportunity to sort of see, how does mom make a living? How does dad make a living? And what does that mean? As they move along, I think as people become more independent, and usually that's in college where you're kind of responsible for yourself to a certain degree. Parents may still be funding the education and helping pay for personal expenses, but that's a time where that you have to kind of manage quite a bit of it yourself. And so I think that's sort of a transition period until after you graduate, when suddenly reality hits. And it's not mom or dad who's paying the electric bill anymore or the rent, it's you. And so I think that it starts in childhood, but then you kind of learn these lessons along the way. But I'm impressed at how many people can recall the first time they did something to make money and what impact that had on them.
I recall working construction in the summers in high school and deciding I wasn't going to do this for a living.
Right.
So that got me motivated for some other reasons. So what are some common mistakes? Maybe you can relate our viewers and listeners to some mistakes they may have made in their investing careers or in their use and handling of money.
Yeah, one of the things that I feel is important is knowing exactly what's coming in and knowing exactly what's going out. And in the one-on-one work that I do with people, I'm surprised at how many people can't answer those two questions. They may sort of know what their income is, they know what their salary is, they might not know exactly the net that comes in on the paycheck. And similarly, if I ask them, have you ever calculated all the expenses that you have going out? They don't know that. So one of the key things that I see as a mistake is simply not understanding what's coming in and what's going out. And you can appreciate as financial professionals, those numbers have a huge amount of impact and meaning for people, because if they don't know that, they don't know how much they should be putting away in investments. They don't know what is available if they want to do some additional investing over what they might be putting in retirement accounts. So that's pretty significant, is simply not knowing. And I think the reason why a lot of people don't know more on the expense side is they're afraid. Either they don't want to tally up debt, for example, or they're uncomfortable sitting down with a household budget and looking at exactly what they're paying out. What I encourage them to do is to try it and to download a budget that they might find online, like a family or household budget, because once you eliminate all of that mystery and they can actually look at the numbers, I think they start to get a better understanding of what the picture looks like.
They can get a clue if they see their credit card bill climbing to the sky, right? That's a clue.
Right.
Yeah.
And yet there's people that stop opening the credit card bills, because they're afraid of what's there. And so that idea that everything that's financial is emotional sort of comes back. But people who experience financial freedom don't have that fear, but they generally know the numbers really well.
That's very true. And when it comes to marriages, money is something that couples tend to fight about a lot, which is probably related to this not knowing what's coming in and what's going out. So is there any particular advice you give to married couples where the root of the problem is money?
Yeah, I mean, you almost want to get to them before they get married and learn a little bit about what their approach will be. Do they intend to combine their accounts or not? And if you think about what a marriage is, you're creating an entity, just like you're creating a business in a way. And I don't mean that in the purely like organizational way, but it's an entity, it's one thing now. I don't know if a lot of people are prepared for what that means in terms of combining debt and combining your resources. Again, it's about what's coming in and what's going out. Or as Thomas Stanley said in the great book, The Millionaire Next Door, you have to be able to play good offense as a couple and good defense, right? So knowing, being on the same page, sharing what your values are around money, and having a combined budget and looking at the numbers again. And I think when you're in this profession, you're so used to looking at numbers, it's hard to believe there are people who don't. But oftentimes if I talk with couples about that exact issue, they don't, it's almost like they don't, it's like, shh, we shouldn't talk about the money part.
Well, talking to my buddies at the tennis club, it seems the best mix is ours and hers. That seems to work real well. So anyway, let's talk about savings. There's some people that are smart enough to say, pay yourself first.
Yeah.
You know, and they get a pay raise and they let that go in, the pay raise go in somewhere, and they're usually in wonderful shape down the road. But that's probably not your average person, is it?
It's not, and it makes me, that question makes me think of the concept of the marginal propensity to consume. It's like the one thing I remember from economics class in college, but it's the idea, and check me if I'm wrong about this because it's not my field, but it's the idea that the more a person makes, the more there's a tendency to use that money for things that they enjoy, to consume it as opposed to saving it. But in looking at that recently, I saw that that's true up to a limit, that once a person has a certain amount of net worth, they actually aren't using any additional income that comes in just for fun or for necessities because they have them squared away. So that part's just sort of interesting. The saving part, as when it's passive, it seems to work better. And the paying yourself first concept is great because you then look at what's left over. And in behavioral economics and behavioral finance, the stuff that you don't see is through money being taken out for taxes, through money being taken out for retirement accounts. The person tends to deal with what's left in the check. And so those methods are really important. And I think that passive savings can help a lot of people build up a nest egg, build up their retirement account, and build up other investments.
I saw an interesting calculation that if a youngster aged 19 to 25 sets aside $2,000 a year and leaves it alone till age 65, they would have more money than someone that started at age 26 and put $2,000 a year all the way up to 65, the power of compounding.
Right.
So if young people can be smart enough to pay themselves first and leave it alone, leave that money alone, it can have huge positive consequences.
Related to that, and it may be just a different way of saying the same thing, but I think the evidence is that the regular investor does better over time than somebody who just periodically does it. That there's something, even if it's a smaller amount, so that getting accustomed to it. The other thing that I often recommend people do is incrementally increase what you're putting away for retirement, for example, because you tend not to miss 10% more. And it relates to a psychological concept called the just noticeable difference. The amount something has to change for you to notice it. You think about listening to music. You turn up the volume a little bit before you notice that it's louder, but there's a certain point where you do notice, and at something below that you don't. So if people can start, just in addition to just regularly putting it away or passively saving, to increase it over time at regular intervals a little bit, that really makes a difference.
Okay.
Well, now, interesting in that Charlie and I, both being professionals in the field for many years, we found that professionals, executives, tend to come to us about 10 to 15 years out before they retire.
Right.
Because that's crunch time in their lives, and they need to figure out whether or not they've saved enough to retire to the lifestyle to which they'd like to become accustomed. Now, sometimes that's not the case, and people aren't waking up until they're in their 40s and 50s, and then they realize, gee, I'm not at the beginning of my career, I'm not even at the middle of my career, I'm on the downhill slide, and panic starts to set in. What kind of advice do you have for those folks?
It can be difficult if somebody has lived sort of above their means, but gotten accustomed to a lifestyle that they could only afford if they didn't invest, if they didn't put money away. And that's a difficult conversation to have because the numbers don't change because the person's upset. The numbers are still what they are, and you probably deal with that more than I do in terms of how to help somebody see what the reality is going forward. If they have gotten accustomed to a certain lifestyle because socially that's important to them, then I have to ask them what's going to be important going forward. Can they dial that back somewhat so that they can live comfortably in the future? Because if not, they're going to have problems going forward that are just going to get worse. As you mentioned at the top of the show, people are living longer, but the dollar is still a dollar. It doesn't increase in value or change because of how much longer you have to live. So putting the money away, recognizing the value of regular investing, and looking at what they have left in a positive way, and asking again, the questions that you probably ask are, what kind of lifestyle do you want? What do you need in order to be comfortable? I found in talking with people, for example, their sense of what they need as an emergency fund, ready cash, can really vary. And you think, well, there should be some standard, maybe it's 3 to 6 months of emergency cash. But I know people who are very uncomfortable with that and they want more.
We have to make this quick, 30 seconds or so, but this is very important, I think. The decision points when the market is crashing and people want to get out, that's when I think we add the most value, and I'm sure that's a lot of what you try to do, just shortly in 30 seconds or so.
About
helping people with that decision not to panic and do the wrong thing, because when do you get back in when the market turns around, that type of thing.
Sometimes I think just helping them look historically at what happened to people who didn't pull their money out when markets went down and what they have now can help. Because if they rely on understanding what other people did to help them make a decision, that can be really important. It's just giving them an example of the person who didn't take it all out, and when the markets came back, how much better off those folks were.
Thank you. This has been a very informative, interesting show. I'm glad you could make it here, and we hope you'll come back again. Okay, next week, our guest is going to be Dr. Oren Gilad. He's the CEO of Atrin Pharma. It's a biotech company, and as we talked about earlier, biotech's a pretty interesting area to take a look at right now. We hope you'll join us next week because your money matters.